Real estate investment entities allow individuals and organizations to pool resources, spread financial risk, and participate in property ownership at levels that may not be possible when investing alone. Previous sections introduced you to real estate investment fundamentals and the distinctive characteristics of real estate as an asset. This section builds on that knowledge by exploring the different organizational structures through which investors participate in real estate. Understanding these entities is essential for real estate professionals because these structures influence taxation, liability, decision-making, financing, and the nature of the investor's involvement. Real estate investment entities exist on a spectrum. At one end is direct ownership, where individuals or corporations buy property themselves and take full responsibility for its management and operation. On the other end are large, sophisticated structures like real estate investment trusts and real estate mortgage investment conduits, which allow investors to participate passively while professionals manage large portfolios of real estate or mortgage-backed securities. Between these are syndicates, partnerships, and hybrid structures that blend active and passive participation. Each structure serves different investor goals, risk tolerances, and levels of management involvement. Direct investment. Direct investment occurs when an individual, corporation, or other entity purchases property outright and assumes responsibility for managing and operating the asset. This structure gives the investor full control over decisions, repairs, tenant selection, financing choices, and long-term strategy. Direct ownership appeals to investors who want hands-on involvement and who prefer to capture all returns from income and appreciation without sharing profits with partners. However, it also exposes the investor to all risks, including operational difficulties, vacancies, market downturns, litigation, and the demands of day-to-day management. Syndicates and partnerships. A real estate syndicate is a group of investors who combine their financial resources to purchase, develop, or operate real property. Syndication allows individuals to participate in projects that would normally exceed their capital or management capacity. Syndicates are organized in various legal forms, the most common being the general partnership and the limited partnership. A general partnership is a structure in which all partners share equally in management responsibilities, profits, and liabilities. A trustee typically holds title to the property on behalf of the group. Because each partner has authority to act on behalf of the partnership, transparency and trust are essential. While this structure provides flexibility and shared decision-making, it also means that each partner can be personally liable for partnership obligations. A limited partnership includes at least one general partner and one or more limited partners. The general partner organizes the venture, manages operations, and assumes full liability for the partnership's obligations. Limited partners contribute capital but do not participate in management. Because they are passive investors, their liability is limited to their investment amount, making this structure attractive for individuals who want financial participation without operational involvement. Limited partnerships are frequently used in large commercial projects, development ventures, and long-term income property investments. Real estate investment trusts. Real estate investment trusts, commonly known as REITs, offer investors a way to participate in income-producing real estate without buying or managing physical property. Investors purchase shares in the trust, and the trust owns and operates commercial real estate or invests in mortgages. REITs must receive at least 75% of their income from real estate activities and meet specific IRS requirements to enjoy favorable tax treatment. When they distribute at least 90% of their taxable income as dividends, they avoid corporate income tax, allowing more revenue to flow directly to shareholders. REITs were established in 1960 to provide everyday investors with access to large-scale commercial real estate. Instead of purchasing an office building or warehouse directly, investors buy shares just as they would buy stock in a company. REITs typically specialize in one sector, such as multifamily housing, retail centers, industrial complexes, medical facilities, hotels, or storage units. Their professional management, diversification, and liquidity make them appealing alternatives to traditional real estate ownership, especially for investors who prefer a hands-off approach. To qualify as a REIT, several conditions must be met. A majority of the entity's assets and income must relate to real estate investments. 90% of taxable income must be distributed to shareholders annually. The entity must be a taxable corporation, managed by a board of directors or trustees, and have transferable shares. After the first year of operation, a REIT must have at least 100 shareholders. And during the second half of the year, no more than half of the shares may be held by 5 or fewer individuals. These regulations promote diversification, transparency, and broad investor participation. 3 primary types of REITs exist. Equity REITs own and operate income-producing property and generate revenue primarily through rent. Mortgage REITs lend money to property owners or invest in mortgage-backed securities, earning income from interest. Hybrid REITs combine both strategies, producing income from both rent and mortgage interest. These structures allow investors to choose a REIT type that aligns with their goals, whether they prefer stable cash flow, long-term appreciation, or exposure to real estate credit markets. Investing in REITs. Most REITs register with the Securities and Exchange Commission. Publicly traded REITs are bought and sold on stock exchanges and offer high liquidity. Investors may purchase shares through brokers in the form of common stock, preferred stock, or debt securities. Non-publicly traded REITs are available through financial advisors or brokers, but are not listed on exchanges. They often involve higher fees, but can provide access to specialized markets. REIT dividends are generally taxed as ordinary income, and gains from the sale of shares are taxed as capital gains. Because REITs eliminate direct management responsibilities and provide professional oversight, they serve as appealing options for investors who want exposure to real estate without the burden of ownership. Real estate mortgage investment conduits. A real estate mortgage investment conduit, known as a REMIC, is a specialized entity created to hold a pool of mortgages secured by real property. It issues multiple classes of investment interests, known as tranches, which divide the cash flows from the underlying mortgages. Holders of regular interests are treated as owning debt instruments, while holders of residual interests are treated as partners for tax purposes. Income or loss from REMIC interests is classified as portfolio income, not passive activity income, meaning it cannot be used to offset passive losses. REMICs gained prominence as a result of the Tax Reform Act of 1986. These structures allowed mortgage-backed securities to be divided into different bond classes with varying maturities, payment priorities, and risk profiles. This customization made it easier for investors to match their investment objectives with specific risk and return characteristics. REMICs are sometimes referred to as collateralized mortgage obligations. Investors include institutions, pension funds, insurance companies, and sophisticated private investors. Freddie Mac's REMIC program played a major role in developing and standardizing the REMIC market. Freddie Mac introduced many structural innovations and continues to offer liquidity, reliable investor reporting, and a wide variety of bond classes. REMICs remain a core part of the fixed income investment landscape because they offer flexibility and predictable cash flow structures. Review summary. Real estate investment entities give investors multiple pathways to participate in property ownership depending on their capital, expertise, and desired level of involvement. Direct ownership offers full control but carries full responsibility. Syndicates and partnerships allow investors to share risks and resources, with limited partnerships offering liability protection for passive investors. REITs provide a hands-off method of investing in income-producing real estate while offering liquidity and professional management. REMICs enable investors to participate in mortgage markets through structured securities tailored to different investment needs. Understanding these entities prepares real estate professionals to explain investment options accurately and responsibly. Discussion: what is the primary difference between a general partner and a limited partner in a real estate partnership? Answer: a general partner manages the operations and assumes full liability, while a limited partner contributes capital but does not manage the investment and has liability limited to their investment amount. Why might an investor choose a REIT instead of purchasing property directly? Answer: a REIT provides exposure to real estate without requiring management, offers liquidity, and allows for diversified investment across different commercial properties. How do REMICs provide investment flexibility? Answer: REMICs divide mortgage cash flows into tranches with different maturities and risk levels, allowing investors to select bonds that match their specific goals. Why are syndicates useful for large real estate projects? Answer: syndicates allow multiple investors to pool resources, enabling them to participate in projects too large or complex for one individual to manage alone. Closing remarks. Real estate investment entities offer diverse avenues for participation in the real estate market, each serving different investor needs. As you progress through this course, your understanding of these structures will support your ability to communicate clearly with investors. Recognize when specialized expertise is needed and navigate complex investment environments. This knowledge is essential for maintaining professionalism and ethical responsibility in the real estate industry.